The stock market has had a fantastic run in the first half of 2024. If you have been investing in 2024, chances are you have made some money. The S&P 500 is up 15% year to date, the nasdaq 100 is up 19% year to date, and my portfolio is up 27% year to date. With the stock market going up, the valuations are also going up, which means stocks are getting more and more expensive. Therefore, it is getting harder and harder to find value in the market. In this video, we will go over 5 stocks I find undervalued, and we will calculate the intrinsic value of each stock using the discounted cash flow analysis. So let's find some diamonds in the rough. Stock number 1, Alibaba. Alibaba stock has had a rough couple of years, even though Alibaba's fundamentals are doing great. Alibaba is down 3% year to date, so basically flat. However, Alibaba is down 76% from its all-time highs in late 2020. On the other hand, Alibaba's revenue has been going up by 19% during this period, and the free cash flow per share compounded annual growth rate over the last 5 years is at 9%. Alibaba's market cap is 195 billion, with 86 billion in cash and 20 billion in debt. This gives Alibaba an enterprise value of 135 billion. On top of that, Alibaba has announced a 25 billion share buyback program. If you look at Alibaba's current price ratios, the PE is at 21, the price to free cash flow is at 9, the price to free cash flow adjusted for stocks-based compensation is at 10, and the enterprise value is at 6. These are very low price ratios. Now let's take a look at discounted cash flow analysis and calculate Alibaba's intrinsic value. If we project 5 years and an 8% free cash flow growth rate, and we assume that the price ratio is going to go up to around 20, and Alibaba keeps decreasing the shares outstanding by 1%, we can see that the calculated fair value today of Alibaba is $148, which is over 100% above the current stock price. So even if these assumptions are off by 100%, Alibaba would still be undervalued or fairly valued. Stock number 2, Celsius Holdings. Celsius Holdings has been one of the best performing stocks over the last decade. However, it is flat year to date, and it's down 39% from its all-time highs just a couple of months ago. I have used this correction as an opportunity to start a position in this company, and I have made a dedicated video analysis of this stock. Check it out if you're interested. Shortly, Celsius is a smaller, fast-growing business which is branded as a healthier alternative to the Monsters and the Red Bulls of this world. Celsius' market cap is 18 billion, and the enterprise value of Celsius is also 18 billion because cash and long-term debt are very close to each other. At the time of their latest earnings report, we can see that Celsius' PE was at 85, the price to free cash flow was at 68, the price to free cash flow adjusted for stock-based compensation is 73, and the enterprise value to free cash flow was at 65. However, since then, the price ratios have come down. If we look at the discounted cash flow analysis for Celsius and we project 5 years, 20% free cash flow growth rate with a price ratio of 50. So basically we assume that the price ratios are going to contract, and we assume that the shares outstanding growth rate is going to be 6%, which has been the last couple of years. We can see that the calculated fair value for Celsius is at around $67, which is around 8% above the current stock price. So Celsius is currently trading closer to its intrinsic value. Stock number 3, Stellantis. Stellantis is an European car manufacturer making cars such as Fiat, Alfa Romeo, Chrysler, Dodge, Ram, Peugeot, Citroën, Opel, etc. As of recently, Stellantis is trying to break into the EV space. Its EV sales in 2023 have grown by over 20%. Stellantis is down 13% year to date and is down 32% from its all-time highs from a couple of months ago. As other car manufacturers, Stellantis faces the same issues, which are high cyclicality, slow growth, strong competition, high capital expenditures, somewhat high debt, etc. The market cap of Stellantis is 76 billion, and Stellantis has around 50.5 billion in cash and 20 billion in debt. This gives Stellantis an enterprise value of 45 billion. The price ratios of Stellantis are very low. The PE is at 4, the price to free cash flow and the price to free cash flow adjusted for stock-based compensation is at 6, and the enterprise value to free cash flow is 4. If we look at the discounted cash flow analysis for Stellantis and we project again 5 years into the future, we assume a free cash flow growth rate of 20%, the same price ratio as it's right now, which is 4, and we assume that Stellantis is going to is going to dilute the shareholders by 2%. We can see that the calculated fair price of Stellantis is $22.5, which is around 12.5% above the current stock price. I currently do not own Stellantis in my portfolio, but given the low valuation, I just might start a position. Stock number 4, Mercado Libre. Mercado Libre is a major Latin American e-commerce business dominating the online market scene in Latin America. It is up 3% year to date, and it's down only 16% from its all-time highs in 2021. It has a market cap of 74 billion, 6 billion in cash, and 2 billion in debt. This gives Mercado Libre an enterprise value of 70 billion. Looking at the price ratios right after the earnings, the PE was at 65, which is relatively high. However, the EPS compounded annual growth rate over the last 5 years for Mercado Libre has been 146%. And that's why the PE is so high. The price to free cash flow is 14, the price to free cash flow adjusted for stock-based compensation is 15, and the enterprise value to free cash flow is 13. These are, in my opinion, very low price ratios for a company that is growing over 100% free cash flow per share on a compounded annual growth rate basis for the last 5 years. If we take a look at the discounted cash flow analysis for Mercado Libre and again project 5 years, we assume a free cash flow rate of 18%, which is very, very low. We assume an increase in price ratios to 20, and we assume that they will continue to dilute the shareholders by 2%. We can see that the calculated fair value of Mercado Libre is $2,652, or around 68% above the current stock price. So again, this is a very high margin of safety, and even if these assumptions are wrong by 50%, Mercado Libre is still undervalued today. Stock number 5, Salesforce. Salesforce is flat year to date, and it's down 19% from its all-time highs from just a couple of months ago. I have made a dedicated video analysis of this stock. Check it out if you're interested. The main concern here is that AI will impact Salesforce's business. But as of now, there is no evidence supporting this claim. Salesforce has a market cap of 225 billion, around 18 billion in cash, and around 8 billion in debt, giving Salesforce an enterprise value of 215 billion. If we take a look at the price ratios, we can see that the price ratios have been going down hard from the previous quarter earnings to this quarter's earnings. We can see that at the time of the latest earnings, the PE was at 41, which is a drop from 71. The price to free cash flow was 20, drop from 31. The price to free cash flow adjusted for stock-based compensation is 26, drop from 44. And the enterprise value to free cash flow is 19, which was a drop from 30 from the previous quarter. Now let's take a look at the discounted cash flow analysis for Salesforce. We again project 5 years into the future. We assume a free cash flow growth rate of 15%, a price ratio of 30, meaning the price ratio is going to go up a little bit, and we assume a 4% increase in the shares outstanding. This gives us a calculated fair value of $360, which is about 56% above the $230 stock price of today. Again, in my opinion, this is a high margin of safety, and I currently hold Salesforce in my personal portfolio. So out of all 5 stocks that we have discussed today, I own 4 stocks. The only one that I do not own is Stellantis. As you may have already seen, I have started my own Patreon. This can be your ultimate weapon for wealth domination. My Patreon members get exclusive access to my own custom-built tools, such as 2 different stock analysis tools, one designed for earnings and one general analysis, complete stock research on my current holdings, research on my best ideas watchlist, full analysis of my past research stocks, access to my personal portfolio, buys and sells, template for analyzing businesses, personal budgeting tool based on the JAR system, including multi-year budget tracking tool, network tracking tool, Q&A sessions, and one-on-one sessions with me. I have put a lot of effort into developing all these tools you see here, and I think they will provide you with a lot of value. You can try it out for a month, and if you don't like it, you can cancel anytime. If you do not want to join the Patreon, then you can also buy any of the tools with a one-time purchase. This will only be a snapshot of the current tool and obviously will not contain future updates. Your support directly helps create the content you see here. Link to the Patreon is in the pinned comment below. Anyways, those were my top 5 undervalued stocks to buy in July 2024. Now, before you run off and invest your hard-earned money, remember that this video is for informational purposes only and it does not constitute financial advice. Do yourself a favor and conduct your own research before making any investment decisions. Finally, don't forget to leave a like on this video, consider subscribing to the channel, and leave me a comment with your favorite undervalued stock for the month of July. Cheers!